Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, October 27th at 7:40 Mountain Time. Markets just opened. It's up 57 handles. Treasury market's up about 1 to 2 basis points across the curve. Our note this week was titled "The Policy Mosaic Endgame," and what we did was we walked through the various changes in policy, what we've been calling the three policy shocks: immigration, government spending, tariffs, and trade policy on the labor market, and describing how the really biggest drag on the labor market this year was monetary policy. And that's been true for 3 years. The Fed's unbalanced policy, easing primarily using their balance sheet and then tightening primarily using rate policy, really damaged small businesses in general, and is why the BLS has been overestimating small business employment for 3 years now. Recall, we got the negative 911,000 first estimate of the annual benchmark revision in the year ended March, and that overestimation of small business employment probably intensified or got larger in the months that followed. But we then took all those impacts on the labor market and then started to talk about our expectations for 2026 and how you will get, undoubtedly, you're going to get easing of monetary policy or a rebalancing of policy that will take a lot of that pressure off small businesses at the same time that the individual provisions of 1BBB, as Joe Livornia, the advisor to the government, described it last week, or dubbed it, I suppose. But that should increase final demand. We haven't seen a pickup in capital spending plans as of yet, but we would expect to see stronger capital spending in 2026 as well, which should increase demand for labor somewhat. And then, of course, we've got all those provisions that those businesses would want to take advantage of. So the outlook for 2026 is better, but for us, it really is contingent upon the Fed cutting the policy rate another 75 basis points between now and March at the absolute latest, which then does bring me to our Fed preview, and we fully expect them to cut 25 basis points. We don't expect Chair Powell to provide a lot of guidance. He'll probably just refer to the summary of economic projections from the September meeting, particularly in the absence of any typical economic data on the labor market. But certainly Friday's CPI report is going to be encouraging for the Fed. Now, what that report did for us, and we included in the email associated with this video, our appearance on CNBC on Friday, where we really made the point that fiscal spending, which is the Fed's blind spot in thinking about the inflation process, we've been very frustrated with how the Fed thinks about inflation. Just go back to March of 2021 when the $1.9 trillion stimulus was passed. 500 billion of checks roughly were sent out to individuals. Goods prices went from slightly negative to plus 12.5% within a year, 12.5% CPI, that is. The Fed seems to be ignoring this. And within Friday's report was a really interesting pattern. For the fiscal year 2024, that ends in September, government spending increased at an 11% annualized rate. Super core services, non-housing services, that is, the portion that you would expect to be most influenced by domestic policy, fiscal policy in particular, went from a 3% rate to a 5% rate. So that's a year ago through September. That's decelerated back to a 3% rate. No surprise, given that fiscal spending in fiscal year 25 slowed to 3%. So it's really does look like fiscal policy is the driver of super core inflation. The Fed never talks about it. Only Waller's ever even mentioned it. And this is really the important factor. Furthermore, on goods prices, there's been all this teeth gnashing at the Fed, concern about tariffs causing a sustainable rise in the rate of inflation. Here's the last 4 months for core goods prices: 0.20, 0.21, 0.28, and 0.22. Now, they were running at zero, so that's higher, but the conditions are not in place to create a sustainable increase in the rate of inflation like they were in 2021. Government spending was increasing at a 45% annualized rate. This year, it's 3%. Money supply growth was 26.7% on an annualized basis in March of 21. It's 4.75%. The long-term median rate is 6.7. The long-term median rate for fiscal spending is 6.5. The conditions are not in place for inflation. The Fed is right to be easing. Forget about the fact that we're at a 3% trend inflation rate. We've only been at below 2 one business cycle in the last 4 decades. It was a target that was intended to try and push inflation up from the zero lower bound. The Fed did not want to go to negative interest rate policy. It was a ill-advised target that was a short-term solution for a problem that was never likely to persist. So that's it on that. As far as earnings go, this is the big week for it. Consumer earnings have been under pressure. Stocks have reacted okay, but Staples margins are at their lowest level in the history of the GIX indexes going back to 1990. We saw it in Procter's earnings most recently. These companies are under pressure. Revenues are weak. Margins are under pressure. That's because of tariffs. We'd continue to avoid those sectors. We like the financials. We got another merger this morning. That's part of our financials theme. But again, to get all these details and our specific recommendations, become a paid subscriber. We'd love to have you on board. Barry Neff from Ironsides. Have a good week, everyone. Thank you.